gentleman's time's expired. Mr.
Thank
Paul?
you, Mr. Chairman.
Thank you, Mr. Chairman. I first want to compliment Mr. Baker for having pursued this issue, and he's been looking at it for quite a few years, and he has kept it alive, trying to point out some of the problems that the GSE faces with the excessive debt and some of the problems that we face. But I think that from the conversation I've heard today is that the consensus is that we just don't have enough regulations, and all we need is a world-class regulator and everything is going to be okay. And I think we're failing to look at the real problem and the cause of our crisis that we face. I'm concerned that we're going to have a world-class adjustment to the distortions that we, the Congress, the Fed, and the Treasury has created over these last several decades, and it seems like there's essentially no concern about that. These programs were originally set up to help people, poor generally, to get affordable housing. And here today we have a program that helps people buy a house and get a subsidy for it in their mortgage payment and get a house for over $300,000. At the same time, the administrators of these programs make millions of dollars. So I think we've lost our way on this. But the biggest concern to me is not looking at the real problem. And to me, it has been this implied credit and an implied guarantee of this credit. But are we going to get rid of this line of credit? Not likely, because that would cause a bit of chaos. But that's really what has blown these markets up, and they're distorted. Also, we have the Fed very much involved in this. They probably wouldn't admit it, but the Fed is capable of, and on occasion will buy GSE securities. Foreign central banks buy these securities because it's implied that the Fed is going to come to the rescue. Right now, overseas, foreigners are buying less of these securities, and the dollar's a little weaker. And what's going to happen when they quit buying them or selling them? And what's going to happen to our investors who buy Fannie Mae and Freddie Mac? When the dollar weakens, interest rates go up. Already the dollar is, or the interest rates are rising long term. And a world-class regulator dealing with that? Not likely. I mean, I'm concerned that there's going to be a panic out of these things as the dollar goes down, interest rates go up, and we still haven't looked at the problem, and that is, you know, this allocation of credit. Taking money out of the market, excessive credit to begin with, because the Fed is pumping it up, just like they pumped up the credit into the NASDAQ, and you had to have a burst in that bubble. Some people think there could be a bubble here. Who knows, though? It might be just a great bit of distortion, but there will be a correction. I'm concerned, and I'd like Secretary Snow to comment on this. Do you ever concern about yourself about what could happen here? I mean, this is a huge amount of debt, a lot of investors, a lot at stake. What happens if mortgage rates go up 3 points in the next year and the dollar keeps weakening? We have a huge current account deficits, and the currency always goes down when you run a current account deficit like this. So I would say that we're missing the whole point here, thinking that all we need to do is come up with a new agency and a world-class regulator, and we're going to do some good if we don't address the subject of the dollar and interest rates.
Congressman, as you know, the dollar and the interest rates are largely a function of monetary policy. Right? And no, we're not proposing to put the Fed under this new regulator. What we are proposing to do is to put these housing entities that have such impact on financial markets under this new regulator, and give that new regulator the complete authority that would be needed to deal with the soundness and safety of the financial system that it oversees. That would be helpful, and some of the issues you deal with are properly approached through a sophisticated risk-based set of capital standards with a sophisticated regulator applying those risk-based capital standards and adjusting the capital requirements to the risks. And those risks include the ones you outlined, the risks of interest rates going up 300 basis points or falling 300 basis points. That's what that sophisticated new regulator would be required to look at. We're saying remove the current statutory restrictions on how you look at risk-based capital. Let the regulator free to apply the most sophisticated and current and modern approaches to the question of appropriate capital structure for these entities. So no, we don't go the whole way here in dealing with some of the external factors that drive these markets, but taking those external factors as something we can't control through this entity, we give the entity the ability to set the capital standards in a way that take those factors into account.
Gentleman's time has expired. The gentleman from North Carolina, Mr. Watt.